So Lowe's just beat EPS consensus for Q2 2026, but they actually missed on revenue.
Yeah, they brought in just under 26 billion. That missed the 26.13 billion estimate,
Yeah.
but they still beat profit expectations,
Right.
landing an adjusted EPS of $4.40 against the $4.22 estimate, though they did trim their full-year guidance to the low end.
Basically projecting around 92 billion in sales, right?
Exactly, and about $12.25 in earnings per share.
Now, if you're holding Lowe's, I mean, you might have expected a sell-off on that top-line miss and, the lowered guidance, but the stock actually rallied over 4% after the report, hitting around $224 a share.
It's wild.
Yeah, so why did the market reward a revenue miss?
It really comes down to the split in who is actually spending money right now. I mean, the do-it-yourself discretionary spending, your weekend warriors buying patio sets and paint, is undeniably
Oh,
weak.
for sure.
But the pro segment, home services, and online sales completely carried this quarter. Online alone was up like nearly 16%.
Wow.
Yeah, and that mix allowed their comparable sales to squeak out a 0.2% gain, which makes this their fifth consecutive positive comp.
Wait, I have to challenge the headline total revenue growth figure they touted, though, which was 8.3%. To me, it feels like they added a brand new wing to a house, and now they're claiming the whole house magically grew on its own.
That's a good way to put it.
Right, because that top-line expansion wasn't driven by everyday people buying more hammers. It was heavily structural. It was driven by their recent acquisitions of Foundation Building Materials, or FBM, and Artisan Design Group.
You can definitely call it inorganic, but acquiring those businesses was a deliberate, strategic shield against the exact DIY weakness you just mentioned.
True.
They aren't just masking a retail slump. They are actively transforming from a DIY-heavy store into a serious B2B pro empire.
Right, by buying up companies that sell drywall and flooring directly to contractors at massive scale.
Exactly. They insulated their balance sheet. And honestly, the market loves that insulation.
That makes sense. I mean, it's a pivot, not just a patch. But I'm still stuck on how they are maintaining profitability. They held a 33% gross margin and roughly a 14% adjusted operating margin, despite, much higher freight and input costs.
Yeah.
How exactly are they offsetting that?
Relentless cost discipline, for one. That, combined with some incredibly effective tech integration. Have you looked at their Lowe AI agent?
A little bit, yeah.
It isn't just a basic customer service chatbot. It's actively helping users build out entire project lists. It finds the exact right fittings or tools for a specific job.
Which removes the friction that usually causes a customer to just, abandon their cart.
Spot on. They're seeing conversion rates literally triple for users who engage with it. They're doing more with less traffic.
Which brings us to the real game of chicken happening in the sector right now, because a decent chunk of their earnings beat, about 11 cents per share, came from an IEPA tariff refund.
Right, the International Emergency Economic Powers Act refund.
Exactly. Basically, the government refunded tariffs previously paid on certain imports. But here is where the strategy gets fascinating.
Yeah, because competitors got similar refunds, and they immediately weaponized that cash.
Right. They aggressively slashed prices on seasonal goods like grills and lawnmowers just to drive foot traffic into the stores.
And Lowe's flat out refused to play that game. They just wouldn't match those unprofitable promotions to buy customer loyalty.
That takes some nerve. But how long can they hold the line on those margins? If you're a cautious consumer dealing with inflation, you are hunting for discounts.
Oh, absolutely.
And with mortgage rates staying elevated, the housing turnover that typically drives these big home improvement projects is, practically frozen.
And that is the core tension for retail investors doing a deep dive on this right now. Lowe's is surviving a sluggish housing cycle by leaning hard into their pro acquisitions.
And protecting their pricing power at all costs.
Exactly. They are controlling what they can control, mainly margins and digital efficiency, while just waiting out the macro environment.
But let's look back at the foundation of that newly expanded house we were talking about. If Lowe's is increasingly relying on these big contractor sales to offset the empty aisles in their DIY retail stores, what happens if higher for longer interest rates eventually crack commercial construction?
That's the scary part.
Right. If the pro side falters, the whole house might just settle.
It is the absolute key risk to watch in the back half of this year. Their shield could easily become a liability if the broader construction market freezes up.
Definitely something for you to mull over as you adjust your portfolios. Make sure to follow the show for our daily earnings coverage so you never miss a beat.